Good morning. How to underwrite exit cap rates correctly, and in doing so, protecting your investments. And if you get one assumption wrong in commercial real estate, it's usually the exit cap rate. And here's the reality: most investors are overly optimistic and have a little bit rose colored glasses. And maybe most deals don't look great on paper because of it. And that's exactly how investors can get burned. So let's break down how to underwrite exit cap rates the right way, like a lender and not a speculator. So, what is an exit cap rate? The exit cap rate is the cap rate that we're using to estimate the future resale of the property. And you're basically what you're saying is it going to be worth more or less over time relative to now? And that formula is the value is the NOI divided by the cap rate. And simple in theory, but it's also dangerous in practice because a small change in the cap rate can equal a massive change in the value. So, why exit cap rates matter more than you think? And most investors focus on simply the purchase price, the current NOI, and the cash flow. But lenders and experienced investors also focus on their exit risk. So, what could the potential market conditions be at the sale? Are cap rates going to expand between then and now? And if your exit cap rate assumption is wrong by even a half to 1%, your projected returns can collapse pretty quickly. Now, the number one investors do make, they assume that the exit cap rate will be the same or lower than today. And that, my friend, is speculation. And in reality, interest rates and cap rates fluctuate, and buyer demand shifts, and risk premiums change. And cap rates typically expand over time and not compress. So, how to underwrite exit cap rates correctly? Well, start with today's market cap rate and look at what's selling in the market. Look for your comparable sales, the asset class trends, the sub-market data, whether it's in Katy, Fulshire, or Houston. An example is, say there's a 6.5 market cap rate right now, and you apply that cap rate expansion, the smart move. So in doing so, professional underwriting estimates, say, a quarter to 1% expansion over the hold period. So if your exit cap rate is 7.25 to 7.5, this is called defensive underwriting and planning for something if things do not go perfectly. 3 is adjust for your asset risk. So ask yourself, is this a Class B or is it more like a Class C type property? How's the tenant quality? How are the leases rolling over? And how's the location going to do over the near term? And higher risk equals a higher exit cap rate. And if you line that with your debt structure, lenders will already be stress testing your deal. So they're asking, what happens if cap rates do expand? And does this deal still work? And is the loan still covered at exit? And if your exit cap is too aggressive, the deal's not going to pass their credit department. So let's stress test your exit scenarios. Run a best case, a worst case, and a conservative case, somewhere in between the two. And an example of that would be, say, assume 7.25 exit cap rate with solid returns, or 7.75 with thin margins, or 8.25 if everything just kind of breaks down. And that's where the real risk lives. Where is that going to fall in those three? So let's talk about local insights for Houston, Katy, Fulshire. And in fast-growing markets like Katy, Fulshire, and West Houston, you'll see strong population growth, but also retail and industrial demand, and a lot of new development pipelines. But here's the key point. Growth does not guarantee cap rate compression. And in fact, rising supply coupled with interest rate volatility and capital market shifts can actually push cap rates higher at your exit. So be conservative is the point, and think like a lender, not an investor. So an amateur mindset might sound like, what's my upside? Whereas a professional mindset might say, what can go wrong with our exit? What could change our exit? And lenders care about your debt yield, your debt service coverage, and your exit liquidity. And your exit cap rate assumption is a core risk metric. So here's the final takeaway for the day. And exit cap rates don't make deals look good. What they do is expose the bad ones. And if your deal only works with, say, a flat cap rate prediction or compression assumptions, and that requires perfect conditions, the chances are that that's really not a strong deal. So, call to action for the day. If you're looking at a deal and want a second set of eyes, I'm your guy. My name is Bill Rapp. Please visit my website, HoustonRealEstateBrokerage.com, to figure out how to get hold of me. Love to talk to you more and have a conversation. Take care.